Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems for Chapter 7, the short exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so let's begin with the first exercise, first short exercise. Let me get my pen. And this is 7-2. So it says classify each of the following item as one of the following. It's either going to be an addition to the book balance, a subtraction from the book balance, an addition to the bank balance, and a subtraction from the bank balance. Remember, when you're doing a bank reconciliation, okay, which is what we're doing here, we're reconciling, we're doing bank reconciliation adjustments. What you're doing is you're comparing your check register, okay, and in this case here, that they're calling that the book balance, all right? You're comparing your check register against your bank statement, okay, which what they're calling your bank balance here, right? So, just a quick theory. You have your check register and you have all of your entries in your check register. Well, just because you make an entry in the check register doesn't necessarily mean that's exactly what happens in the bank statement. So what you're doing is you're looking to see whatever's in your check register that's not on your bank statement and putting it on the bank statement. And then what you're doing is you're going to look at your bank statement because let's say, for example, there's a non-sufficient fund charge and that you didn't enter into your check register. So you're going to be looking for things that are on your bank statement that are not on your check register, and you're going to put it on your check register. So when you take all of these entries and you add in whatever is from the bank statement, you get a balance. And then you also do the same thing with the bank statement. You take all of these entries and you add in whatever you have from the check register, and you end up with a balance. And that those two balances should be equal. Okay. If they're not, then there's something wrong, and you have to find why it's wrong. All right. So that's the whole quick rundown on doing a bank reconciliation. And how does that apply to this problem? Well, what we're doing here is we're looking at these common different things and determining where we should make that adjustment. So like, for example, our outstanding checks, okay, they should be a subtraction. Instead of I'm going to write them here. That should be a subtraction on your bank statement, okay? So any outstanding checks that you have on your check register should, which means, I wrote a check, let's say it's check 108 for $350, right? And if I wrote that check and I put it in the mail, if I wrote it on the last day of the month, it's not going to be on that bank statement, all right? So I have to subtract it from the balance in the account as if it was actually cashed, right? All right, deposits in transit, same thing, but that's going to be in addition to the bank statement, okay? Deposit in transit, meaning I put a deposit, but it's still into the bank, but it still hasn't showed up on the bank, so I would have to add that money to the bank statement. A non-sufficient fund check, right? That would be a subtraction from my book or my check register, right? Meaning, if the bank charged me for something, and if I don't have it in my check register, then I need to add it and subtract it from my balance, because that's money coming out of my account. Right, bank collection of our note receivable. That's an addition to our book or our check register. Okay, if we have a notes receivable, it is possible for the bank, for the, think about your mortgage. This is the best way to think about this. Your mortgage is generally handled through a bank, okay? The money doesn't go right into a mortgage company. So you make your payments to the bank, and then that money sits in there as part of escrow, and then the mortgage company takes that money and then pays taxes and things like that. So a bank collection of a note receivable, so somebody owes you a note receivable, and that would go to the bank, and when that money goes into the bank, obviously you have to add it. If it's in there, then you add it to your check register. Right? If you forgot to do it, that's why you're doing this reconciliation. Interest earned on a bank balance, again, that's in addition to the book. And that generally you're always going to have to, you're never going to, it's highly unlikely you're going to know exactly to the penny what that balance is going to be. All right, so you're generally going to have to look at your bank statement, see what the interest earned is, and add that to your check register. Okay, same with a bank service charge. That's going to be a subtraction from your check register, from your book. I mean, that is generally a common charge. Maybe it's like $1.50 for all transactions that you have once a month. But sometimes if you're, you might have something like you pay $1 a month and then say 10 cents a check. Well, you don't know which checks cleared the bank, and they're going to charge you, for each check that clears the bank. So you actually have to wait to see the bank the bank statement in order to know what that bank service charge is going to be. Okay, a book error where we credited cash for $200. All right, and the correct amount of the check was $2,000. All right. So this here is a subtraction from my book. Why? Because I was supposed to make it for 2,000, but I only made it for 200. All right. It's an error in my book. All right. So, if, for example, I'm supposed to write in my book 2,000. Okay, but I don't. I only write 200. Well, the bank gets it and it shows 2,000. Right? Well, there's an error of $1,800 that I have to, take out of my check register. Okay, so that's the error correction in your book. And then the bank error, the bank decreased our account for a check written by another customer. All right. Well, we're going to have to add that back in. So we're going to add that to the bank, meaning if I had a balance of say 10,000 and the bank made an error and there was a $2,000 charge to our account because of another customer, right? In other words, it belonged, that they cashed that check for this other customer to our account when it shouldn't have been ours. Well, the bank is showing 8,000. Well, when we see that, we're going to say, hey, that's not our check. That belongs to this other customer. So we have to add that $2,000 back in to the bank statement to get the balance, because that never really existed, okay, to get our balance back to 10,000. Right? So that's it for 7-2 for the short exercise. Let's see about 7-3 and how long this would take. Let's see here. Prepare a bank rec. The T account for cash and bank statement for Sinclair Food Services for the month of October follows. Okay, so this is the cash account and this is the bank statement. Prepare a bank reconciliation. Okay, we can do this in a relatively short period of time. This is our general ledger cash account. Now remember, I had said we're reconciling our check register against our bank statement, right? Now, what actually happens is basically you have a ledger, right, that you put all of your transactions in. That you also want, so there's like 3 different entities here, okay? You have your check register, you have your general ledger cash account, and you have your bank statement. Right, so what ends up happening is Um, the general ledger cash account obviously is in your ledger, but you keep a separate check register to keep track of your cash, because you're not always going to be posting your journal entries to your general ledger cash account every single time that you make, you write a check or you make a deposit. You might only post to your cash account, once a day, maybe twice a week, maybe even only once a week. Okay, but you have transactions occurring on on an ongoing basis. And so you generally keep a check register in order to keep track of your cash in this ongoing basis. So what you do at the end of the accounting period is you also have to reconcile your check register to make sure it's the same as your general ledger cash account, meaning anything that's in the check register should have had a journal entry, and those journal entries should have been posted to your cash account. So you're always constantly looking to make sure that these two are the same. All right. Then at the end of the accounting period, all right, you go and you say, okay, I get my bank statement. Now I want to reconcile my bank statement with my check register. Okay. So if these are equal, then, and you've made the journal entry, anything that's different in your check register that should have been made, any adjustments that should have been made, you're going to make journal entries and you're going to post them so that they get posted to the general ledger or cash account. So by reconciling your bank statement with your check register and then posting those journal entries, that should make your general ledger cash account be the same as your bank statement. So you have this, all three should be, reconciled to the same amount. Okay, so there's really three parts. Now, here for this exercise, they're just saying, okay, let's just look at the cash account. Okay, so really what they're saying here is we're not looking at our check register because we've posted everything to our cash account and it's still the same. Okay, so we're looking at our general ledger cash account, which should be the same as our check register, right? All right, so we're going to do this bank reconciliation. And the way you do it is on one side, you put your bank, well, they're calling it a bank, and the other side, we're calling it the book. Okay, the book is our cash, our GL cash, or our check register. And of course, the bank is the bank statement. So we have to start out with our beginning balances. All right, so we have beginning balances. And on our check register, on our bank statement, that's $3,890. And on our check register, we have this pre-adjusted book value of $2,605. Now, it's easier to do one and then the other. Don't do both at the same exact time. Okay, so let's start with the bank side here. All right, we're going to go and we're going to say, okay, on October 1st, we need to see that there is a deposit here of $33.10, which we see right there. I'm sorry, that's our beginning balance. All right. Maybe I should clarify this a little bit. I wrote beginning here. Really, this is the ending balance on the statements, right? It's the ending balance on our bank statement and the ending balance on our check register. I called it the beginning because, I treat it as it's the beginning of the reconciliation, okay? But really, it's the ending balance, all right, on the two statements. So just to kind of clarify that, all right? All right, so, from our general ledger cash account, we had $33.10, which is what our bank statement was. Okay, so we know that's okay. Then we have a deposit of $925 here, right, which we have here. So that hit our bank statement. We have a deposit of $240, right? Well, we see that that deposit of $240 is not on our bank statement. So we have to add that in to the bank, all right? So we have a deposit for $240. that we're going to add in. So that gives us, that's the only thing we have on that side. So that gives us now a balance of 0, 3, 1, 41.30. Now let's take out, let's see what we have to take out. All right, so we have this here is okay. All right, we have a check 704 for 640. Well, there it is right there. So that's on there. 705 for 300. That's on here. But we have a check for $930, which is not on our bank statement. So we have to, let me erase this here. So then we have to we have to take out our outstanding checks, or outstanding is how I generally write it. So we take out our outstanding check of $930, which is a subtraction because it's money coming out of the account, and that means our balance should be $3,200 as an ending balance on our bank statement. Right. Now we went and we did it one way. We looked at our register and we compared it to what was on our bank statement, and anything that was in our register that is not on our bank statement we put on the bank side. Now we do the, we go in the opposite direction. Okay. We come over here to our bank statement, right? And we say to ourselves, okay, what's on here that wasn't up there? Now we know this 925 was is in both places, but we have a $630 deposit that we don't see up here in our check register. Okay, so we have to add that in. Add a deposit of $630. Well, that's that bank collection, right? Let's not call it a bank collection. Let's call it. So we're going to add in bank collection of $630, and we also see that there's interest, right, of $5. So we're going to add that in, right? So this is money that's coming in. So when we add that in, we have a balance of $3,240. Now we have to look at things that we have to take out. So less. We had, this check was taken out. This check was taken out. There's nothing left there. But we have other charges. We have a service charge of $40. So let's take out the $40. And that's the only other thing that's on this statement. So now we have a new balance of $3,200. Okay, and our accounts are reconciled because our bank now has, with all of the adjustments made, we're saying that the balance in that account should be $3,200, and for our check register, the balance in our check register should be $3,200. When we add these into the book, into our check register, so that we know that our balance is $3,200. Obviously, we can't do that to the bank statement because you actually have to wait until the deposit comes and the outstanding check comes. But when they, if no other transactions occurred and those deposits and those outstanding checks hit the bank account, the bank balance should end up being $3,200, and then that should match our check register. So that's a bank reconciliation. Okay. That's it for this video. We'll move on to the next video, to the next problem in the next video. But it did occur to me that, when it came to the theory, remember I had pointed out that you should go back to the Math for Business / application section of the student community and watch the theory videos for doing bank reconciliations. You see one in the textbook, you had them in the math book. This chapter has a lot of bank reconciliations to get a lot of practice. So I'm not, I'm kind of like covering the theory at the same time of actually doing the application aspect of it. But if you want a more solid understanding of the theory, go back and watch the videos that are on the student community. Okay, with that said, I'll see you in the next video.